Introduction. AirAsia Group Berhad is a well-known Malaysian airline company. It offers affordable air travel options to a wide range of destinations. AirAsia was founded in 1993 by Tony Fernandez. Since 1996, it has experienced significant growth and has become one of the world's most successful low-cost carriers. The company changed its name to Capital I Berhad in 2022. The rebranding represents the group's shift towards an investment holding company encompassing a portfolio of interrelated travel and lifestyle businesses. Current financial status. The COVID-19 pandemic significantly impacted Capital A, resulting in a substantial downturn in its core business. However, the situation took a positive turn in 2023, with AirAsia's financial position experiencing significant improvements. The revival of international routes played a crucial role as Capital A achieved a noteworthy increase in revenue of over 2.5 billion ringgits in the first quarter of 2023, a three-time increase from the same quarter of last year. The company also witnessed a surge in net profit of over 57 million ringgits compared to the net loss of over 903 million ringgits during the previous year. Additionally, AirAsia Super App witnessed a substantial revenue surge of 175% compared to the same period in the previous fiscal year. Similarly, BigPay, another business under AirAsia umbrella, experienced impressive growth with quarterly revenue of 11 million ringgits.
Now we move to the assessment of Capital A's financial performance for the years 2021 and 2022. We start with net profit margin. The net profit margin in 2021 was negative 221.09%. This indicates that the company's expenses and costs exceeded its revenues, resulting in a significant loss and poor operations. In the following year, in 2022, the profitability ratio improved to negative 51.33%. While this is still a negative ratio indicating a poor performance and loss, it also means that the company reduced its negative profit margin by 169.73%, which is a notable improvement in the profitability ratio. Although there was an improvement, a negative profitability ratio over 2 consecutive years is concerning, as it signifies ongoing financial challenges and potential difficulties in sustaining the business. Next, we have the current ratio. Capital A had a current ratio of 0.27 in 2021. However, in 2022, the current ratio decreased to 0.17, signaling a decline in liquidity. The group suffered a 37.03% decrease in liquidity from 2021 to 2022. The decrease in the current ratio raises concerns about Capital A's ability to meet its short-term financial obligations. A low current ratio also indicates that the Capital A may be facing cash flow challenges. It could imply that the company is experiencing cash outflows that are outpacing its cash inflows, indicating difficulties in managing working capital. Observing the statement of cash flow, changes in working capital declined from 2021 to 2022. More specifically, receivables and prepayments declined remarkably from 11 million ringgit in 2021 to negative 740 million ringgit in 2022. Moreover, inventory further declined from negative 12 million ringgit to negative 51 million ringgit. This indicates that the cash outflows are more significant than the cash inflows, which is a potential red flag when it comes to liquidity. Next, we have trade receivables collection period. The trade receivable collection period has decreased significantly from 94 days in 2021 to 31 days in 2022. This decrease suggests that Capital A has improved its efficiency in collecting payments from customers. This indicates that the Capital A's receivables receive payments more quickly by 63 days. Observing the formula and figures, the change in trade receivables was an increase by about 110 million ringgit, which is relatively insignificant. However, Capital A's revenue spiked in 2022 by 4.17 billion ringgit, improving Capital A's efficiency. Consequently, the improvement in the cash collection is reflected in a more efficient trade receivable collection period of 31 days. Next, we have leverage. In both years, Capital A's leverage ratio was negative, indicating a highly leveraged position. In 2021, Capital A had a leverage ratio of negative 4.12, which increased to negative 3.09 in 2022. The company experienced an increase of 22.57% in leverage. A higher leverage, a higher negative leverage ratio indicates a higher proportion of debt relative to equity, suggesting a higher level of financial risk and potential difficulties in meeting debt obligations. One possible reason for the negative leverage is a negative equity value. According to Capital A's annual report, the equity deficit for the year 2021 is negative 6.2 billion ringgit and further decreased to negative 9.5 billion ringgit. Although the leverage is negative, it increased from negative 4.12 to negative 3.09, and this is mainly due to the increased total liability. The company might have taken on additional debt during the year. Capital A's total liability increased from 3.8 billion ringgit to 4.1 billion ringgit in 2022. The increase in negative equity coupled with the net increase in liabilities will result in a higher leverage ratio. And lastly, we have earnings per share or EPS. EPS demonstrates how much money a firm earns from its shareholders. EPS is an excellent basis for determining stock prices and widely utilized metric for evaluating corporate value. Regarding Capital A, its EPS was recorded at negative 0.79 in 2021 and increased to negative 0.65 in 2022. This signifies a marginal increase in earnings per share over the recorded period. That is because in 2021, Capital A's net loss was 2.9 billion ringgit and it was reduced to negative 2.6 billion ringgit. Despite this relative positive change, the average number of shares increased from 3.78 million in 2021 to 4.05 million in 2022. The increase in the average number of shares and the relatively small decline in losses helped improve EPS marginally by 0.14.
Now, we will be looking at the trend analysis for Capital A and its competitor Ryanair from the year 2018 to 2022. We will be looking at the same ratios used from the financial performance analysis, starting with net profit margin. In 2018, Capital A had a healthy net profit margin of 15.94%, indicating a profitable operation. In 2019, however, the net profit margin took a negative turn, reaching negative 2.39%. In 2020, Capital A experienced a drastic decline in profitability, with the net profit margin plummeting to negative 179.82%. This sharp decline is due to the impact of the COVID-19 pandemic on the airline industry, such as lockdowns and travel restrictions. Capital A faced significant revenue losses and struggled to cover fixed costs, leading to a substantial decline in profitability. In 2021, Capital A's net profit margin further worsened to negative 221.09%. In 2022, Capital A's net profit margin increased to negative 51.33%. Even though the net profit margin increased, it was still in the negatives due to the slow recovery as new COVID-19 variants emerged in 2021. In contrast, Ryanair exhibited a more resilient performance in terms of net profit margin. In 2018, Ryanair's net profit margin stood at a strong level of 20.28%, indicating a profitable operation. There was a decline in 2019 and 2020, with the net profit margin falling to 11.50% and then to 7.64%. This was due to the rising jet fuel cost in 2019 and reduced passenger demand and widespread flight cancellation caused by the pandemic in 2020. While the net profit margin for Ryanair dropped into the negatives in 2021, reaching negative 62.06%, it still demonstrated a relatively better performance compared to Capital A. The drop in net profit margin in 2021 for Ryanair can be attributed to the delayed effect of the pandemic, as Western countries were not as strict as Asian countries in 2020. However, in 2022, Ryanair experienced a significant recovery, with the net profit margin improving to negative 5.02% as vaccination efforts progressed and travel restrictions eased further. Moving on to current ratio, Capital A has shown a consistent decline in its current ratio over the years. Starting with a healthy ratio of 1.29 in 2018, it decreased to 0.74 in 2019, 0.32 in 2020, and further down to 0.27 in 2021. Capital A's current ratio reached an all-time low of 0.17 in 2022. In contrast, Ryanair's current ratio trend tells a different story. The company began with a relatively healthy ratio of 1.23 in 2018. It slightly declined to 0.93 in 2019 and then declined to 0.82 in 2020. In 2021, the ratio significantly increased to 0.98 and continued to rise to 1.01 in 2022. Although the ratio is merely at 1, the upward trend suggests an improvement in Ryanair's ability to meet short-term obligations over time. Capital A, as an Asian-based low-cost carrier, operates in a region that faced prolonged travel restrictions and reduced passenger numbers due to the pandemic. The decrease in travel demand led to a reduction in cash inflows, making it challenging for the company to maintain a healthy level of short-term assets relative to its liabilities. On the other hand, Ryanair, a European low-cost carrier, also faced challenges during the pandemic. However, European countries implemented measures to support the airline industry, including financial aid and less severe travel restrictions compared to some Asian countries. The relatively better economic conditions in Europe, along with government support, may have contributed to Ryanair's ability to improve its current ratio. Moving forward to trade receivable collection period, Capital A shows significant fluctuations over the years. In 2018 and 2019, the average collection period is around 8 days. This indicates that Capital A was able to collect payments from its customers within a reasonable time frame. However, in 2020, there was a sharp increase in the collection period to 48 days, and it further increased to 94 days in 2021. This is due to the fact that Capital A's customers experienced financial restraints due to the pandemic. However, in 2022, there was a significant improvement as the collection period decreased to 31 days, indicating a positive trend and potential recovery for Capital A. In contrast, Ryanair demonstrates a much shorter trade receivable collection period throughout the years. The collection period for Ryanair remained relatively stable and significantly lower compared to Capital A. This indicates that Ryanair has been successful in collecting payments from its customers in a timely manner. The consistent low collection period of around 2 to 4 days reflects Ryanair's strong business model, efficient operations, and effective credit management. The global economic conditions and real-world factors such as the pandemic did not have a major impact on Ryanair's trade receivable collection period. This can be attributed to factors such as Ryanair's extensive route network, cost-effective fares, and its ability to attract a large customer base, allowing for better cash flow management and collecting prompt payments. Moving on to the leverage ratio for Capital A in 2018 was 2, indicating a moderate level of debt relative to equity. However, in 2019, the ratio increased significantly to 7.79, suggesting a higher level of leverage and potential financial risk for the company. The increase in leverage can be attributed to factors such as increased borrowing. In 2020 and 2021, the leverage ratio became negative at negative 6.56 and negative 4.12 respectively, indicating a negative equity position for the company. This could be a result of significant losses or write-downs that have eroded the company's equity base. The negative leverage ratios in 2020 and 2021 indicate the severe impact of the pandemic on Capital A's financial performance. However, in 2022, the leverage ratio improved to negative 3.09, suggesting a reduction in debt relative to equity and a potential sign of recovery. In contrast, Ryanair demonstrates a relatively stable leverage ratio over the years. The ratio for Ryanair ranges from 1.4 to 2. This indicates a moderate level of debt in relation to equity, implying a balanced financial structure. The relatively low and consistent leverage ratio for Ryanair indicates a more resilient financial position and a better ability to withstand economic fluctuations or disruptions. Lastly, Capital A's earning per share or EPS trend shows a consistent decline during the analyzed period. In 2018, the EPS was 0.59, but it turned negative at negative 0.09 in 2019. Increased expenses and reduced revenue contributed to this decline. The situation worsened in 2020 with a further drop to negative 1.53 as the pandemic caused travel restrictions and reduced passenger demand. The EPS improved slightly in 2021, reaching negative 0.79, but ongoing financial difficulties and the emergence of new variants hindered full recovery. In 2022, there was a partial rebound with the EPS improving to negative 0.65. Although the gradual resumption of air travel and easing of restrictions provided some opportunities, challenges and uncertainties persisted for Capital A. Ryanair's EPS trend also fluctuated but exhibited a relatively more resilient performance. In 2018, the EPS was 1.21, declining slightly to 0.77 in 2019 due to rising jet fuel costs. The pandemic significantly impacted Ryanair's financials in 2020, with the EPS decreasing to 0.58. However, compared to Capital A, Ryanair showcased a relatively better performance. In 2021, the EPS turned negative at negative 0.91, influenced by the delayed effect of the pandemic in Western countries. The recovery became more evident in 2022 with an improved EPS of negative 0.21. Vaccination efforts and the easing of travel restrictions supported a rebound in passenger bookings and revenue for Ryanair.
In conclusion, the financial performance of Capital A Berhad has severely been impacted by COVID-19. The net profit margin for Capital A has shown a significant decline over the years, with consecutive years of negative numbers indicating financial difficulties. Also, the company's current ratio has consistently decreased, highlighting its struggle to meet short-term obligations. Capital A's leverage ratio has also been volatile, with negative values indicating a weakened equity position. Capital A's earnings per share trend has also been consistently negative, showing declining profitability and challenges in generating shareholder earning. On the other hand, Ryanair, a European low-cost carrier, has demonstrated more resilient financial performance compared to Capital A. Despite facing challenges posed by the pandemic, Ryanair has maintained relatively high net profit margins, a stable current ratio, and a moderate leverage ratio. The company's earnings per share trend has also shown a more favorable performance compared to Capital A. Overall, the financial performance of Capital I Berhad indicates significant financial difficulties, primarily caused by COVID-19. In contrast, Ryanair showed a more resilient performance due to better European economic conditions, government support, and relatively more lenient COVID restrictions. Recommendations: if the potential investors are risk-averse, they should not invest in Capital A due to the financial difficulties. However, investing in Capital A is recommended if the potential investors are risk-seeking and can take the chance it may improve its financial performance during recovering from COVID-19. Even though Capital A's financial performance is bad, the ratios significantly improved from 2021 to 2022. Also, Capital A has ventured into the digital travel and lifestyle industry through BigPay and AirAsia Super App. Capital A's venture into the digital travel and lifestyle industry will undoubtedly grow soon, meaning the company will experience an increase in revenue and profit over the coming years, rewarding risk-seeking investors with higher returns.